We're going to calculate the stock price for Waste Management. And the first step is we need the market cap, which is 45.1 billion. And we'll put that into the model. Now we need the stock price, 106.75. Now if you take the market cap, divide it by the stock price, you get the shares outstanding, 422 million shares outstanding. Now we're going to look at the free cash flow. And the best way to calculate the stock price for a company is to project future free cash flow and then discount those dollar amounts back to today's value. And that's exactly what we're doing in this video. So Waste Management, Tony Soprano's company. Next we need net income, which is on the income statement, and that's the profit and loss. And last, we need revenue. And as you're entering numbers, even if it's into a model, you should always be looking at the numbers. That's kind of what I'm doing, looking how they move. Because one number on its own is meaningless, but you got to compare it to, like for instance, revenue 2016. That's meaningless to me. I need to compare it to revenue in other years to see if it's higher or lower and how it moves. And they've been on a steady increase, although a small increase, but it's an increase, which is good. Net income has been increasing, then it decreased. Cash flow has been on a steady increase. So these are all good signs so far. Now we need to look at the capital structure of Waste Management to figure out the discount rate we need to apply to the future cash flows. So the interest expense on the income statement is 411 million. The short-term debt, we got to go to the balance sheet, the liability section. The current debt, 218 million. And then the non-current debt, the long-term debt, 13 billion. That's debt due beyond 1 year. So it's a really good interest rate, 3%. Interest payments are tax deductible, so let's find their effective tax rate. We'll go back to the income statement. Income before tax, 2 billion. Income tax, 400 million. So the effective tax rate is 21%. So the cost of the debt is 2.4%. And the weight of the debt this company has in their capital structure is 23%. So it's okay. That's an okay number. It's not great, but as long as it's under 50%, it's manageable. Now we need to figure out the cost of equity, and first we need the beta to do that. We'll go to Yahoo Finance. The beta 0.75. That's a really good beta. That means it's not volatile stock. And to figure out the cost of equity, we use a CAPM model, capital asset pricing model, and we come up with 8%. And as you can see, equity is 8%, debt is 2.4%. Equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, debt holders are paid first, then equity holders. And usually equity holders don't receive anything, maybe 1 or 2 cents on the dollar. So that's why they require a higher return, because they are taking more of a risk. So now we have the WACC, 6.8%. That's a blend of the equity and debt. And this is the discount rate this company should be using to take on new projects. And this is the discount rate we're going to use for the free cash flows. So we calculated free cash flows for 2020, 21, 22, and 23, as you can see here. And all the cash flows after 2023, we did that at one shot. We call that the terminal value. We used a Gordon growth model or dividend discount model to figure that out. We discounted the number back to today's values. And then the value of the company is $40 billion. When you divide that by 422 million shares, you get a stock price of $95. It's trading at 107. So it's trading at a 12% premium. So we consider this a sell. Now let's look at the historical stock price. And it was trading around 95 a couple weeks ago, or a month ago. But a few months ago, it was trading well above intrinsic. Stocks generally trade above or below intrinsic value. because the stock price is really based on the demand of the stock. If people think the stock is going to go up in the future, they're going to bid the price up. And if people think it's going to go down, they're going to push the price down. More people are going to sell the stock if they think it's going to go down. So some companies make no money, so their intrinsic value is nothing. But yet their stocks are through the roof because they see the future of the company better than the current or the past. So everybody has their own opinion on a stock, on a company, but this is my model, it's my opinion. So thanks for watching.